Okay, good morning, everybody, and welcome to the Gulf Intelligence Daily Energy Markets Forum webinar, where every morning in the Middle East, we take a quick review of where markets have opened in Asia and the direction of travel through the day. As always, Monday morning with our regular commentator, Mr. Omar Najia, Global Head of Derivatives of BB Energy. Omar, immediately the markets have opened up this morning in Asia, popping above $50 a barrel. It would appear on the back of news breaking out of Saudi Arabia of a ship explosion that occurred while an oil tanker was discharging. What's your read on the markets this Monday morning?
No, so basically I don't like, well, let's put it this way. I think if you look at Brent and you look at TI, they're both lower than we were last week, right? So we set a high at 47.76 on WTI. It's trading 47.02 now. So, even after the ship, we're actually lower than we were. But bottom line is I expect these markets, like I was saying last week, to go higher. The target now, we took out that 47.20 I was talking about last week. So I think basically before, most likely basically before we see a retracement, I think we could get to, let's call it $50 on WTI. So plus or minus $3 from where we are now. When we get to... Well, I mean, no, it's not going to be this week and definitely not by like 3 o'clock on Thursday, but I think next couple of weeks, we should see WTI get to $50, Brent get to $3.53, something like that. I think the S&P is going to go higher. Very interestingly, I was talking.
And these would all be expectations before the end of the turn of the year as such.
Yeah. I think basically, look, something very interesting. I like Bitcoin and I like Bitcoin a lot. And over the weekend, last week, market was pressured a little bit. We got down to 17,800, something like that. I was sitting here Saturday, Sunday. I looked at the market. We popped back over 19. We went to about 19,200, something like that. And I think Bitcoin is to me, or is behaving very much like a risk on or risk-taking kind of proxy.
Is it emerging yet, Omar, on Bitcoin that it has any correlation in terms of direction of movement like gold and dollar and so forth?
No, so basically usually what happens is that, Bitcoin was trading or people were arguing that Bitcoin will trade with gold. So gold goes up, Bitcoin goes up. There's just like a differential, but same direction. What's happened now, very interestingly, I was talking about this maybe like 2-3 weeks ago, was basically that it's gone like this. So gold has gone down, Bitcoin's gone up, and Bitcoin's actually gone up more than the S&P. It's very interesting. So I think basically, no, in terms of correlations only work in terms of fixed times. So they can be correlated for a week, a month, a year, blah, blah, blah. And between various asset classes, but the correlation, it does not basically stay for a lifetime. Sometimes they are, sometimes they aren't. It just depends. Right now, it's an inverse correlation between gold and Bitcoin. And again, I don't think it has very much to do with dollar weakness or dollar strength, because we've seen Bitcoin go up while the dollar was going up, and we've seen it come down when the dollar was going down. But it's very interesting. I think it's a proxy for risk taking. In other words, we're looking for the markets to go higher across the board. You have this vaccine rollout also, and you have Bitcoin basically signaling that people want to be taking risks. So I think I'm confident in the view basically of high prices.
Kevin Wright, lead analyst APAC for Kpler. Kevin, we've seen now again this morning in Saudi, as I mentioned, the news reports of the explosion on the ship. It's the latest in what is a series of small kind of pinpricks on energy infrastructure in and around the kingdom and the Gulf in the last few weeks. The last time we saw that, time is when was it a year ago, 18 months ago, let's say 18 months ago, we saw a series of incremental sort of pinpricks that rose and rose. The market's ignoring it. What's your own thoughts?
I think the word small and the phrase pinpricks is absolutely spot on. There's a big difference between sort of relatively isolated, limited impact attacks like this one, or explosions or whatever like this one, and say the attack that we saw on the Abqaiq facility a couple of years ago. You know, the Abqaiq attack had the ability to change market sentiment, albeit on a short-term basis, but it certainly spooked the markets at that time. I think the way that the market has responded, I think Omar's absolutely spot on, is it's just digested this as a very small matter. I think the UK Navy, which is linked to the UK MTO, is sort of saying this is not something that we need to take on board as for a change in strategy. It's an isolated incident, and therefore, you know, we don't need any sort of significant change in mentality or activity. And I think the markets are looking at it the same way. They're saying, yeah, we will continue to see these pinpricks, but they're of limited impact, and therefore the markets themselves will see limited impact on price.
Looking into Asia, Kevin, and storage in general, floating storage, etc., as we sort of firmly anchor back into a market structure of backwardation, what is the outlook, do you think, for storage, and will it continue to draw at a pace that might accelerate?
Yeah, and you've got to take the two sort of aspects of storage in a slightly different way, because obviously you've got landed storage, which has, in certain countries, certainly China, very limited flexibility. Once the crude has gone into inland storage in particular, that's not coming back out again. That's going to get processed, digested by refineries inland. Some of the coastal terminals, say Mercurius facility, for example, yeah, that will respond to changes in market, and you might see potentially a re-export. So what you're going to see on the landed storage situation is a gradual drawdown as the market doesn't incentivize to store, right? And that's going to be via reduced imports potentially into China and the normal functioning of the refining complex. But if you then look at the floating storage, which is much more discretionary and much more sensitive to market changes, even in the last week where we've seen the gas oil curve giving less incentive to store, i.e., you know, your contango is gradually disappearing, we're starting to see a drawdown, certainly around Southeast Asia. You know, so we had 8 or so million barrels of clean product stored, gasoline, diesel, jet, predominantly around the sort of the part of the world where I'm sitting, and that's drawing down by about 2 million barrels over the course of the last week as traders respond. So again, as I say, you've got to sort of take what I would call the systematic drawdown in China and other places where the crude is being processed versus the trading-led discretionary drawdown, which is all economics driven on the floating storage.
Let's welcome in Dr. Andre Bellier, CEO of Balsen, sitting in Europe. Andre, I can't remember if there was a year since the Second World War where twice, that's 4 actually, twice in 1 year, the British have been told not to stockpile food. Here we had the headline again today in our digest. This time on Brexit 6 months ago, it was on the back of the COVID crisis. What's happening in Europe, and should we care?
Well, let's say that the pandemic still continues, and it has an effect on general economic developments. And in addition to that, well, as you are speaking about Britain, we are in the uncertainty about the way how the United Kingdom will exit the European Union, and the consequences of a hard Brexit might be very dire for the United Kingdom and for the pound. And here I would let's say catch up a little bit from what Amar was saying, that it seems like gold, the confidence in gold gonna go back because of the uncertainty that we face both with the British pound and with the Eurozone difficulties and with the United States, who will certainly turn the dollar machine up. So regarding European Union, one of the positive sides is that the budget has been finally agreed. That's actually good news. However, a lot of challenges ahead because the plan that the European Union sets is very ambitious. And now, because of the ambitious plans, the ETS price, so the price for carbon, is growing. And that certainly will be an added challenge to energy markets, particularly for coal power plants. So it's quite an interesting game here because on one hand, the ETS price is growing, gas prices are rebounding, and
I mean, LNG into Asia is bouncing off the ceiling. It's quite amazing at the moment. Andre, you articulate this kind of two things happening at the one time this weekend, which was, as you say, the passing of the stimulus $1.9 trillion European Union budget. But the second part was the announcement that countries in Europe are going into even harder lockdowns. The biggest economy in Europe, Germany, announcing that they were basically going to hermetically seal the place over the Christmas season.
Yeah, certainly it's a very big challenge, and that's challenging first of all for the aviation sector. Hence, aviation sector is the biggest incremental sector where the incremental demand has been expected for the next decade, and we don't have this growth in the aviation sector. By contrast, because everybody's sitting at home and the weather becomes colder, gas demand is boosting, and then we see a very good withdrawal season from underground storages, which again stimulates the gas demand. And I think
it seems like everybody is coming to Dubai. It looks like there might be an exodus out of Europe. Omar will be renting out his extra bedroom by the looks of it. It's so busy at Dubai airport the last few days. Omar, you mentioned there that you expect this trend to push WTI up into above 50, joining Brent above 50. I'm wondering, what impact will this current cycle? I mean, typically second half of December, people get distracted by the holiday season. What will keep the momentum of this market as traders like yourself switch off and start carving your turkey?
Well, I mean, the focus is making money, right? So you're going to have to take a bet. Either you think it's going up or going down or going sideways. So I think most people, I mean, you know, what's interesting is that a lot of people expect markets in particular, all of them, to be quote unquote range bound. So if you ask people, what do you think about Brent, let's say, they'll go, well, you know, let's say $40 to the low side, $60 to the upside. And I think there's a lot of that in markets, including, you know, S&P, including basically even gold. People will say, well, it could really go to 2000, and then it's supported at 1800 and all the rest of it. And usually what happens when you have a lot of this kind of, you know, complacency that you can't go too high, you can't go too low. If you go too high, OPEC will do this. If you go too low, OPEC will do that, all that kind of stuff. So I think basically that range is going to be broken. And if you ask me, that's going to be broken to the upside and not the downside. I have no idea what OPEC Plus will or won't do.
But you do know, one thing you can say is they're going to be meeting a lot. That's virtually meeting.
Yeah, they're going to be meeting a lot, but even
including this week again, JMMC meets, I believe, tomorrow or the next day.
Yeah, but even if you look at LNG, I mean, LNG is going through the roof, and it's not going through the roof. I mean, not only at the beginning of the year, in October, the backwardation on LNG was 5 cents. It's now blown up massively. That does not happen for any reason apart from demand. You can say whatever you like, but basically what's happening is that China, because China is growing, the JKM marker is basically a marker that's directly related to China. So JKM against anything else, TTF, against Henry Hub, against NBP, against any of them is blowing, and that's only because of demand. And it's, yes, people want to stay warm and whatever, but industrial use, electricity, needs, all this kind of stuff, that's also going through the roof. So there's something basically, you know, the idea that we only go so far and then we come back to the upside or downside, I think is dangerous. I think basically the market needs, I mean, the anticipation to make money is making people front run this market a little bit on hopes, positivity.
I mean, Omar, you have been typically a sort of advocated caution when all the herd is moving in one direction. And we are now, sort of clearly moving. The equities have been that way for a while. The commodities are now in the same space. How does that make you feel when everything's moving in the same direction? All players are running in through the same door.
That's what I'm saying. I think basically, if you ask people now, most will be on saying that range bound, i.e., to here and maybe a little bit higher, blah blah blah. There's not many people who tell you, oh, the S&P is going to go up 25% next year. They'll tell you, well, maybe 5%, maybe. So I think basically there's this pent up energy in markets, whether it be to the upside or downside. I think people want to get involved. There's a lot of money sitting on sidelines that's been sitting on sidelines for a very long time. I think they want to participate. So if you look at the market the way it is now, either we go sideways, stay within a range, which I think is the least likely option, or we go hard up, or we go hard down. And between those two, I think we go hard up. I think commodities, I think emerging markets, I think less to do with the West and S&P and all that kind of stuff. But China, I think they will follow as well. But I think basically I'd look for a break of that range to the upside, new highs on the S&P, short-term targets, 3,700, 3,800, something like that. Long-term targets. Long-term doesn't mean, means 2021, something like that. 4,600. So
but it seems in some way this world that supposedly has no inflation, and yet the equity markets and the financial markets in general, Kevin, do all seem to be where all inflation is parked. Kevin, meanwhile, China is getting on with business, and the new year is coming. The buying spree there should continue through to the first quarter solidly at this point, as we're now trading contracts into February.
Yeah, I think that's right. We've seen strong imports throughout the year, particularly sort of May onwards, when we saw that massive influx of crude from the Middle East and even from the North Sea. And I think there's no real reason to think that that's going to stop. Chinese domestic margins on gasoline and diesel are pretty decent. The export margins on gasoline in particular are very decent. So we're going to see the refining machine carry on. And that means obviously we're going to see continued crude imports. Can I come back to a comment that Omar made just a moment ago about LNG? And I think he's absolutely right. Just before we came on air, I was looking at the relative levels of LNG imports into China, South Korea and Japan in the last year or so. November versus November, we actually saw a slight increase, about 700,000 cubes extra imported in November. But in December, we're showing something like 39 million cubes. In December of 19, we saw almost 42 million cubes. At the same time as those imports, we know that the Japanese ministry is predicting a colder than expected or a colder than average winter. So we're going to see extra demand, and at the moment, we're not seeing the supply. Now, Omar's absolutely spot on. Whether it's been gasoline...
We're not seeing the sorry to interrupt, Kevin, you're saying we're not seeing the extra supply of LNG that's needed.
Yeah, we're not seeing the supply that would keep us in line with sort of inventories where we had them last year, with an average to mild winter. Now, if the Japanese government is coming out and saying the winter is going to be cooler, and yet we're 2 million cubes in deficit versus where we were last year on imports, then that suggests, again, it's all supportive, it's all to the upside. I mean, this whole year, whether you look at gasoline in the States in the middle of the year, or we looked at refining margins, in the second quarter, it's never been about supply. It's always been about demand, and that's going to continue to drive. There is no shortage. I mean, Matt Stanley keeps harping on about this in his daily commentaries. There's no shortage of oil in the world, despite the OPEC production cuts. So it's all dependent on consumers. It's all dependent on industrial activity and personal mobility. And that's going to continue into the winter and into the first quarter of next year.
Andrea, we're seeing in different ways, and as was announced over the weekend with the European package, that the acceleration towards the carbon and gas, obviously it's LNG, gas has its place in that transition fuel. We've now seen in the last week Denmark announced that it was going to stop oil production offshore, not immediately, but in a notable time period. The British announcing over the weekend that they were no longer going to fund overseas investment in oil and gas. And now overnight, we have in our digest today, the New York pension fund, government pension fund, saying they were going to divest from oil and gas. How do you look at those combination of factors? Market seems to be continues to sort of disregard these developments, at least on the front end. I'm wondering, do you expect that this will really anchor into Europe and become an accelerator, these targets?
It has been an accelerator. If you basically look at the European history, the recent European history, of course, well, Europe has been already on the path towards, let's say, a certain level of decarbonization. When you look at the European Union's dynamic in greenhouse gas emissions, in man-made greenhouse gas emissions, they have been declining. So that basically this European approach somehow enters in line with what have been happening before. Just now, it has amplified the objectives a little bit more ambitious, and yes, they're gonna have an impact. I don't want to say that the oil gonna disappear, of course not. Moreover, in order to fuel the energy transition, one needs to have a higher oil price. Yeah, it's very difficult to convince the economy to switch from oil when you have low oil price. Yeah, so basically the transition needs the higher oil price, and also the transition needs lower natural gas price, but the natural gas prices are recovering, whereas oil prices remain low. So basically there are a lot of headwinds, as you correctly said, on the market side against the energy transition. However, when you look at the companies, how the companies react towards the European Union ambitions and towards the bankers' changes priorities, yes, companies are thinking how do they portray themselves greener than before. So yes, the European targets will have an impact.
Well, I think that the interesting thing, I mean, there's many things interesting about what's happening in Europe and post-COVID, these accelerated transformations. It'll be very difficult to get banks to finance if you get governments backing away from providing sovereign guarantees across their supply chain moving into, I mean, in the Middle East here in the UAE, there'd be hundreds of British companies operating in the oil and gas supply chain.
Yeah, basically, I would say that's pretty an earthquake for many. And I don't think it's going to be very good for the energy transition either in reality, because if, for example, some countries, smaller, poorer consumer oil countries, will lack funds and lack possibilities to import oil, their populations might cut wood. And that's not good for the climate neutrality, right? But what we observe is indeed a shift in the financial world, let's say, to be more cautious about investments in oil, and probably the risk assessment, the discount rates for oil investments going to change.
Yeah. Let's go to the survey question and then have the panel give us their outlook for the year ahead. I mean, ultimately, this is the last session with our 3 guest speakers this year. And although we're obviously continuing through the end of the week, but in terms of Kevin and Omar and Doctor, this is their last session. So I want to get their views, big picture on what the next year might look like. And we're setting up with the same question we're asking through the week. What will be the average price of Brent crude oil in 2021? Closer to 40, 50, or 60? The average price of Brent crude oil in 2021. And then we'll go around the table and get everybody's views on what next year might look like, at least from the headlines point of view. Omar, let's kick off with you. 2021, how do you see it in terms of the sort of the bigger themes and what might carry over from 2020? Is it all recovery? You're saying it seems to me that it's all upward from your perspective. You're on mute, Omar. Sorry, you're on mute.
So you're going to see basically, in my opinion, you're going to see whether it be energy in general, be it LNG or nat gas, go higher still. I think the structure will improve as well, more backwardation. Same with oil, higher numbers, backwardation, the end of free money in the contango. Equities, higher equity prices. I think basically in terms of the dollar, I think the dollar index is trading like 90.70 right now, 90.7. I think it makes a low at 90 and then rebounds higher. So I'm not looking for dollar weakness. I'm looking for quote unquote dollar strength, considerable dollar strength. Inflation and gold, I'm not at all convinced. I think basically what's happening now, it's people are buying or the market is taking on debt. So basically what's happening is people are buying Apple as a company rather than buying Apple products. That does not cause inflation. The world is, in my opinion, deflationary. So you have a lot of spare capacity. Whether you look at whatever you look at, you have a lot of spare capacity. So it's not inflation. Printing of dollars is not actual printing of dollar bills. It's actually taking on debt, allowing people to take on that. So again, Apple, not iPhones.
I mean, Apple is nearly like a sovereign country now with a AAA rating where people are just sort of parking their money instead of the bank.
Exactly. So I think you see more of what we're seeing now, you know, less malls, less shops, you know, more internet, more Bitcoin, more that kind of thing. But I think
where are the risks?
I think basically the risk is further forwards in time. So you're in a kind of race. At some point down, you know, how do you get this market back to reality? So it's like the analogy I use is a train. So basically, you keep having to speed up and speed up and speed up and speed up, and the train is going to speed up. So at some point, you're going to have to slow that train down to normal speed. But if you do, then you risk the whole thing kind of exploding. So it's an exit risk. I don't know whether that is a year from now, 6 months from now, 5 years from now. I don't know. I'm hoping it's more than a year, but I don't know exactly. But at some point, you're going to hit the buffers in a big way. But I don't know when that is.
Yeah, it could be tomorrow. Kevin Wright, your views on 2021. Where do you think the big picture is?
Going back to a point I made, a point Omar made, and a point many of your panelists have made. Just on that, thanks very much for this year. It's been very entertaining and great to be involved in the webinars and the podcasts. But the key point is all about demand. If we see demand recovery into next year, then we can see a relatively supportive environment for crude ultimately. I think then it hinges on the JEMMC and the nations involved in that organization, because if we see sort of fledgling recovery in demand and OPEC and the JEMMC respond too quickly, then we get very quickly into a situation of oversupply and we'll see prices come off again. Now, I actually think that OPEC's been very, very responsible this year. They've been very, you know, sort of aware of market changes and of their impacts on the market in terms of price and direction. So I think we will continue to see decent sort of stewardship of the OPEC vessel, and therefore we'll see a gradual increase in supply so long as the market can digest and absorb it. But I think, yeah, we're looking north of 50 next year rather than south of 50.
And what about Asia in general, China in particular? Obviously, terrible year for everybody, but China is the one economy that will end the year in positive growth territory. But does China get back to the big numbers of growth again, or are we now permanently kind of in this, you know, under 5% China growth? What's your own thoughts for the outlook for Asian macroeconomic health next year?
I mean, if you look at China and you look at the GDP growth numbers that are put out by the government every year, they started sort of getting into the double-digit percentages on a yearly basis in the sort of 2005, 2006, etc. And that means that every year you get that double-digit growth, your economy overall is growing underneath, right? The base load, if you like, is getting bigger and bigger and bigger. So to achieve the 6 and 7% that we've seen now, you're looking at almost double the growth in actual dollar terms that we saw 10 years ago. That's incredibly difficult to sustain or to maintain. So I think China cannot, despite its perhaps own beliefs, cannot exist on its own. It needs export markets. It needs demand for whatever it produces. be that diesel, be it toys, be it computers or iPhones. Sorry, Omar, shouldn't mention iPhones. But the point is, you know,
he buys them every week, for God's sake.
Well,
he's on iPhone 25 already.
He's buying Apple shares, not iPhones, by the sound.
Exactly. That's right.
Help in the long run.
That's the wise thing to do.
But the point is, you know, China, as I say, can't exist on its own. It's going to face headwinds at some point, and when the base load gets so high, you can't be looking at 7 and 8% on a yearly basis. You've got to say, well, within the context of the struggling world economy, that's an unrealistic proposition. You're not going to get the 7s and 8s. You might get the 4s and 5s.
And that's big enough, as you say. And we also, I would say, on China, need to increasingly be getting closer to the sentiment that we trust your data numbers every week, every month. Given the scale of the economy, we can no longer have this sort of cloud of, well, you're not sure, is China's numbers accurate?
Yeah, and I avoided making any sort of pseudo-political comment about the veracity of those numbers. Thank you very much.
I'll do it for you. Dr. Andrea, before we give you the last word, let's get the survey question result and see where the room is. Closer to 50 seems to be the continuous sentiment. Dr. Andre, obviously you're sitting in Eastern Europe. A new year comes. Russia's still sitting there quite strongly with its shadow over Eastern Europe. What does 2021 look like, do you think?
No, I don't have a crystal ball either. Well,
but you have a good brain.
Depends. But what I'm afraid of that the crisis will continue, because there is no silver bullet against the pandemic, against COVID, and we should not be illusioned about a quick solution with a vaccine. A real effective vaccine takes about 2 years to be tested and stuff like this. We are not there yet. And what's also important is to see how long all the economies will recover after the crisis that we've had. And when you look at all the small businesses which collapsed, right? Because I'm living in a very touristic city. Now the tourism was over, was out. And so basically, I would say 1 out of 3 businesses were closed in the meanwhile. So you imagine—
What's the city, sorry?
Tallinn in Estonia. And then you can imagine what are the effects, midterm effects of recovering all the economy, because states don't get money from the middle class. Middle class needs to have a support. Then there is a gap to support other sectors, including R&D, including intervention in other sectors of economy. So the delay of the economic recovery will be stronger than what we have seen in 2008. Yeah, and for the markets, what's actually problematic for the markets? In 2008, we learned how to live with the risk. Now we learn how to live with uncertainty.
Well, it would appear that none of you have mentioned the geopolitical risk in 2021, which is obviously still there. What are your own thoughts on that? Anything you would point to, Dr. Andre?
Certainly, international tensions will continue and will get amplified. I don't have much trust in the fact that the Obama administration will be able to correct all the deeds which were done by his predecessors. Tensions with China seem to continue, and transatlantic distrust appeared, and Russia becomes more assertive in many ways, and I would say tensions surrounding the post-Soviet space, excluding the Baltic states, might also continue in the near future. So I would say the next year might be quite challenging in terms of—
as Santa Claus says, you can't all get your Christmas presents. One of the things that hasn't been, built into the financial markets, it would appear, is that everything goes perfectly well. The vaccine rolls out perfectly. The economies recover perfectly, and then the valuations that we're currently seeing in the financial markets become justified. But in the world that I know Omar lives in, as he always says, nothing goes up in a straight line. I think that will be the case of 2021. I think 2021 is sell the news. 2020 was buy the rumor. I think 2021 is sell the news. But nonetheless, Kevin, Dr. Andre, and Omar, thank you so much for your wisdom and insights this season. Have a very Merry Christmas, and we will catch you up in the new year. As everybody knows, we have the January 13th forum. All of you guys participating, attending, please spread the word on that from a registration point of view. Everybody can watch it on LinkedIn as well as join us on Zoom. But we'll run through the week, so we hope to catch up with some of you through the rest of the week. But until then, thank you, Kevin. Thank you, Dr. Andre. Thank you, Omar. Have a good day. All the best.